Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Hey everyone, I'm Jeremy Szafron. This is Kitco News on location in beautiful Boca Raton, Florida for the Rick Rule Symposium. Now it's a great day here and investors are on the prowl looking for opportunities. We also had Jerome Powell speaking in front of Congress. We've got lots to get to. It's a busy day. Our next guest is no stranger to the Kitco audience. She also worked for the Fed for over a decade. So let's get her take. Let's welcome Danielle DiMartino Booth. Thanks for making the time for us here at Kitco, Danielle.
Happy to be here today.
I just came from your chat and there was so much to get into. I'm going to have to get the audience kind of briefed here. But before we do, Jerome Powell just sat down in Congress. And I think you and I got a little note of what was happening during that chat.
We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
So, I mean, again, do you think Powell is reacting a little too late now?
Well, aside from being Captain Obvious, yes. And I actually think that Jerome Powell knows that he's late. I think there are a lot of other factors that are driving his commitment to keeping interest rates higher than the economic data warrant. And I'm not even so sure that I disagree with those motives of his, because we have seen in the years that have followed the Great Recession, the Great Financial Crisis, we have indeed seen a lot of actors in the financial system kind of run off the rails. So somebody needs to do something.
Yeah. So if it is too late, I mean, we're not going to get into a forecast call on the rate cuts. We will in a moment, but he's calling maybe September, the market pricing in, possibly two before the end of the year. I mean, we know that the markets always overrun this news. They kind of, get excited on it. What are your thoughts?
Well, I think what was most intriguing was that the year started out with 6 to 7 potential rate cuts, and now I think markets are underpricing how much Fed easing will occur if he's able to get past a very large revision to data for the fourth quarter that comes out on July the 24th, so a week before the July 31st FOMC. If that doesn't make enough of a ripple in the headlines such that he can press forward to get to September the 18th, he really will have waited for too long. Right before the Great Financial Crisis, I think the Fed waited for 15 months. Right now we're at 12 months since that last Fed move. So the longer he waits, typically the larger the rate cuts. So we could get to September and it might be 50 basis points. And it might be followed right after that in the November the 7th meeting and right after that in the December meeting, such that we could possibly have 150 basis points of rate cuts in theory if he's going to be playing catch up.
So if he's playing catch up and we have an election coming, depending on who's in office at that time, what's the outcome?
I think he's been forthright. People love to attribute political motivations to everybody. But he was asked several meetings ago about, well, gee, the September meeting is right before the election. Don't you think that optically that would suggest that you were trying to sway the outcome of the election? And when he was asked that question by a reporter, he kind of went off script and got a little angry. And he said, no, every meeting is live. And no meeting will be motivated by politics. So if it is September the 18th that is the launch date for the rate cutting cycle, that will have nothing to do with politics. And I take him for his word because he has yet to be motivated by either presumptive nominee.
And I mean, I don't think he's well liked by either candidate at this point, right? I mean, there's some history there. It's probably not a positive one.
On both sides.
Yeah.
So, but again, he's a true fiscal conservative, always has been. Unlike Ben Bernanke, people forget that he left the Republican Party. Ben Bernanke, after he left being chair at the Fed, I don't I don't see that forthcoming from Jay Powell in May of 2026. I think he'll remain true to his Republican, fiscally conservative roots.
Yeah, interestingly said. Okay, let's get into your talk here at the Rick Rule Symposium. It was fantastic. It was filled with insight. Right off the top, you mentioned that stocks don't matter, flows do. I want you to kind of give some context here, because as we hear from Jerome Powell, as we see these revisions in the data, we're knowing that there's some cracks here. So let's get into that.
So I think what people should appreciate is whether it's the money supply you're talking about, or whether it's the size of the Federal Reserve's balance sheet. What matters to markets is at the margin. If you're talking about government spending, if government spending is increasing, but a lot of it is going towards interest expense, and at the margin, the government's not making new expenditures, giving people more money, then it's going to feel contractionary. Because it's the flows, it's what occurs at the margin that creates growth or the absence of growth or contraction that matters to markets the most. And I think that that's why we've seen stocks continue to hit all-time highs, but it has been a grind. It really has been a grind. And that comes down to the fact that if you look at the largest stock exchange traded fund in the world, the Vanguard All Stock Fund, it's pretty much flatlined for all of 2024. What does that indicate? It indicates that the flows into the stock market have really plateaued, albeit at a high level, but not enough to press stocks to that huge next milestone. The same applies to money supply. The same applies to government spending. And at the margin, we're just not seeing it.
Yeah, I saw a chart this morning with the S&P, and it was interesting watching those magnificent, which almost become about 3 or 4 now. They're the only ones that are above that level. Everything else on the S&P is kind of down. Mm-hmm. So, I mean, are we in a recession here? We had Claudia Stamm on the show. We talked about the Stamm rule. Seems to be the case. Your talk, you said maybe since October.
I actually follow the McKelvey rule back to 1968. It also has a flawless track record. It's an 0.3 percentage point increase rather than the Stamm rule, which is an 0.5% increase. That was triggered in October of 2023. Bloomberg Economics came out about a month ago, I want to say, and they said that they also see net job losses as having commenced in October of 2023. We saw a large revision to non-farm payrolls that showed that in the 3 months ended September the 30th, 2023, we saw net job destruction, negative 192,000 jobs. These are real numbers, and they're hard numbers as opposed to the Bureau of Labor Statistics, which is survey data. This is data from U.S. employers that is handed in on a quarterly basis to the U.S. Census Bureau about companies' headcounts. And once that math is rectified, we've been seeing net job losses that we know of since the third quarter of 2023, which goes right there with the McKelvey rule being triggered.
Right. I mean, it almost seems like we should be looking at different data before releasing it and getting the market excited, no?
Yes.
Real time?
It's true, but I'm going to speak out of the other side of my mouth, because what the stock market cares about is when the Fed actually moves. So we really don't tend to see a correction begin in earnest until the Fed actually lowers interest rates, and that's just historically speaking. That doesn't mean that on average stocks are not going to lose 32%. That's what history dictates in the post-war era. But it means that there's not going to be a rush for the exits until the Fed actually moves.
So does that also mean that if the Fed does, say, move in September, that we might see these all-time highs continue to succeed until that point?
Very likely, because that's typically how it has worked. You want to press the envelope as long as you possibly can. And again, you could go back to the Nifty 50, you can go back to the heights of 2000. I mean, we had a lot of ups and downs in 1999 and 2000 before the bottom simply fell out. And we've certainly had a lot of ups and downs in the post-pandemic era, but we haven't had anything stick.
Yeah. I wanted to get into jobs and incomes, but you talked a little bit about being musked up on that stage. Now, for the audience, of course, Twitter executive Elon Musk came in, bought Twitter, cut 75% of the workflow, cut the fat, right? And to your point, a lot of Silicon Valley followed. So talk to me a little bit, talk to the audience, explain what happened.
So what appeared to be radical at the time, and when I say Musk, I have to spell it M-U-S-K-E-D. That's what Silicon Valley CEOs, they felt like they'd been skunked. Because everybody assumed that Elon Musk was going to fail, that the World Cup was coming up, that football fans from all over the world were going to be crazy, and that on one particular Sunday, shortly after he'd done that headcount reduction, that Twitter was going to crash. and it didn't. And the light stayed on. Elon Musk has had to do a little bit of backtracking. He's had to do a little bit of hiring back of certain employees. Once you cut them all, you're like, okay, wait, that person was essential in hindsight, and bring them back. But a lot of CEOs have continued down this path. And by the way, Elon Musk cutting to the extent that he did preceded the revolution in artificial intelligence, and how many employees being replaced, especially at a middle management level, by artificial intelligence, and or I can work from anywhere, translating into the offshoring of white collar positions to places like India and the Philippines, which has happened in the post-pandemic era. Millennials insisted that they could work from anywhere, and the message finally hit home in the C-suite, and fine. Now they're in Mumbai, and for a third of whatever they were earning before.
Right, and it seems like others have followed. Do you think this will continue? And more importantly, what does this do for job numbers? What does this do for the economy?
So what we tend to see at this particular point in a cycle, and it's kind of, if you think back to late 2007 going into early 2008, we had been seeing the unemployment rate tick up 0.1 of a percentage point at a time, tick, 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 tick. And then all of a sudden you get into the spring of 2008 and boom, you're seeing 0.3 of a percentage move, larger moves up. And I think that this particular earnings season is going to be a wake-up call for everybody who still believes there might be a soft landing. I don't see how you do that given the magnitude of the revisions and the fact that we have so many negative signs in front of job creation. But I do think that CEOs and CFOs will take the opportunity of this upcoming earnings season to be even more aggressive in terms of we're announcing our earnings, and with it, we're announcing deeper job cuts than we had originally anticipated.
So with all that stimulus that, the government fed the economy, and then of course, I want you to explain this a little bit. When people got laid off, explain PIP. Obviously, they got a little severance package. They had a little bit of capital. Is the stimulus gone, is my question.
So, and that I think is what people have a harder time understanding. The plug was not pulled on the employee retention credit, the ERC, until September the 14th of 2023. So we're just about to round the 1-year anniversary of the last time there was real hard cash being pumped into the economy by the federal government. And that's why we've seen the economy slow. Danielle, October 2023, it looks like that's when net job losses began. The fiscal flows had slowed the month before. And in addition to that, we saw an increased pace of bankruptcy filings. Standard & Poor's Global came out and said just yesterday that we've seen 436 Chapter 11 filings this year, the highest since 2010. So at the same time, the fiscal stimulus is kind of, those spigots have been turned off. We've seen an increase in the number of store closures, liquidations. So unlike 2023, which was a very polite white collar job market recession where you got 6 to 9 months of severance, 60% of your pay, your lifestyle wasn't really affected. 2024 is like 2023 on steroids. It's hurried up because a lot of the job losses that we're seeing this year are triggering 60 to 90 days of severance. And that's why we're seeing the very steady march increase in jobless claims week after week. Finally.
So we're starting to see it now, and it almost seems as though, people understand that this debt crisis isn't really going anywhere. I mean, there's a lot of people in a lot of trouble, unfortunately, a lot of people being pinched. With the economy, are we just going to see this in real estate? Are we going to see this in earnings? Are we going to see this all across the board?
So I think earnings and sales expectations are too high at this juncture. And I think that's why C-suite occupants are going to remain in cost-cutting mode. I think the household balance sheet is impaired. The average U.S. household is spending more to service non-mortgage debt than they are to service their mortgage debt. We've never seen this. It's unprecedented. And commercial real estate continues to be a very impaired sector. Again, if you're Joe Q, Jane Q, CFO, CEO, and you've got a lot of your employees in Mumbai, if you're John Deere and you've just shuttered your operations in the United States and you're moving a huge factory to Mexico, these are things that impair paychecks. They hurt households, they hurt communities, and they take time to recover from. And certainly what you're going to see in terms of the fallout for commercial real estate is going to last a long time.
So talk to me about the banks. What are they going to do about this situation?
Well, it's the banks are in a difficult spot. It's very trying to broker marriages Because as we know from Silicon Valley Bank, which seems like it was a dog year ago, a lot of banks got in over their heads in terms of their holdings of treasuries and mortgage-backed securities on which they're still sitting on deep losses. So in addition to that, trying to have one bank buy another bank, that means they have to purchase those losses, as well as this great big unknown of what are the losses in your commercial real estate portfolio? Gee, I don't know. So it's a much more difficult proposition for the FDIC to facilitate bank mergers in 2024 than it was in 2009.
What's this going to mean for the regionals and the small communities?
I think we're going to have to get pretty creative. And I think that there may end up being, depending on capital requirements going forward and to the extent to which they increase or not. I think the FDIC, the OCC, the Federal Reserve, I think that they're going to be more challenged in trying to make sure that we don't lose too many of our small and regional banks, because then we would go from being a country largely of oligopolies out of Silicon Valley to also being a country of just a few banks.
Yeah. Talk to me about the consumers. You brought up this interesting aspect about, they're still buying. Even if they don't have money, buying. People are still buying. People are still buying cars. They're still buying things.
I've started really to follow payments.com. They put out some great survey material. And to hear that, of the Americans who are living paycheck to paycheck, 47% are still planning to increase their vacation spending this summer. How? Well, like 24% are going to use buy now, pay later to increase their spend on vacation. The stimulus checks, the extra unemployment benefits, we forget that Trump tapped FEMA to extend them. Trump tapped the Centers for Disease Control to extend the rental eviction moratorium. Foreclosure forbearance did not end until November of 2023. We've trained a lot of American households to think that obligations are kind of iffy. An obligation, not so much an obligation. Student loans, we're going to give you 4 years where you don't have to pay for them. A lot of people have not tuned into what the repercussions are of not satisfying your obligations, your debt obligations. I think that does begin to change on November the 1st of 2024. There are 20 million Americans who have begun to repay their student loans. There are 19 million Americans who are in arrears and delinquent and have not begun to pay their student loans since that clock started ticking November 1st of 2023. This year, though, they'll be reported to the credit agencies, and it will hurt their credit, and that will come as a shock to consumption.
Yeah, wow. So many revisions. Okay, before I let you go, because you are the most popular one at this show here.
Gracious.
I'm curious, we got to talk about the election. We got a lot of things going on with that, between Trump, between Biden, his poor performance. I'm sure you watched the debate. Yesterday was a little bit of a comeback story. They put him out on the air and said, okay, here you go. Let's stick to the economy. If Trump gets in, what's going to happen? If Biden gets in, who's going to fix this mess?
That's a good question.
Is anyone thinking about it?
No, we haven't had two presidents in post-war history who've spent more. So there's a strange kind of to the death competition between those two individuals and or any of the individuals who are being battered about as being potential replacements for Biden on the Democratic ticket. My greatest concern, and I tell people vote, is that in a nation where checks and balances still apply, it might be Congress as what's going to stop the spend. Because we know on day one that if a hypothetical future President Trump was to be elected into office, those tax cuts would not sunset. That's another $5 trillion that you can tack onto the nation's debt. And that there would be all manner of stimulus spending if past is any precedent. And I certainly don't think that would be, I don't think we'd see fiscal prudence coming out of a Democratic administration either. So again, I keep telling everybody when they ask me about the question of politics, be very careful who you vote for Congress, because maybe it's Congress that acts as the retaining wall and stops the spend.
Interesting. So the Fed won't step in this time to save it?
I don't think that this Jay Powell Fed will necessarily step in blindly and monetize all of the debt. There was a global pandemic at the time, even though some people believe or do not believe in its existence. But absent a cataclysm, an Armageddon type of moment, I don't see this Jay Powell's Federal Reserve, which he will be in office until May of 2026, stepping in to blindly monetize every last penny of additional marginal spending. The flows matter.
Fascinating. Thank you for making the time. As always, we appreciate you coming on Kitco.
Thank you for having me.
I'm Jeremy Szafron. For all of us here at Kitco News, we want to thank you for watching. We're here at the Boca Raton Rick Rule Symposium in Florida. Now, of course, we got lots of great content coming your way all week long. Be sure to hit that subscribe button, like this video, and we'll see you next time.
Kitco News special coverage of the Rule Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.